Why we're inverting, let's put that aside for a second, but still, banks might not loan as much. Higher borrowing costs will hurt any kind of expansion. How do you factor that into your thesis?
Well, we certainly monitor the yield curve, and we think its trend is of concern. We think it's going to flatten further for the next few months. So that is of concern, but we don't overweight that for reasons related to the dramatic distortion in the Treasury market that has happened over the last almost a decade. And it's not just in Treasuries, as we know, it's in European assets and Japanese assets as well. So interest rate curves are heavily influenced by QE and other central bank behavior, and also by issuance patterns by the Treasury. And so we think when you add it all up, this curve is somewhat distorted by those policy moves, and so it's not as disconcerting as it might otherwise be.
And we also hear from various Fed members that they are sensitive to this issue. They're paying attention to it. That may affect how rapidly they raise. Well, my question is really, how sensitive is either GDP growth or earnings of corporations to the rate? I mean, that is to say, it's between 2.75 and 3.5. Does that make a big difference in terms of overall growth of the economy or earnings for corporations?
I'm not an economist. I defer to Paul and Bricklin, who are U.S. economists on that specific topic. But I do think that unlike other regions, for example, Europe, where bank lending is a far greater proportion of the financial markets, the slope of the curve has a bigger impact both on savers and on lenders. In the U.S., as you know, there have been this huge boom in alternative credit providers as a result of the regulation of the banking sector. And so there are huge pools of money that are a lot less sensitive to the slope of the curve and much more sensitive to actually generating return. And so a flattening curve doesn't necessarily cause them to stop lending. In fact, we see that in the low end of the credit market, and the leveraged loan market, and the mezzanine debt market. There's ample money there for transactions. So I don't see that slowing down lending activity as much as in prior cycles.